Welcome back. In this video, I want to talk about the Registered Retirement Income Fund, or the RRIF as it's commonly known here in Canada. Essentially, the RRIF is a way to get money out of your RRSP when you retire. By December 31st of the year that you turn 71, you will have to close your RRSP account, and you're going to have three options. Option one is going to be just take out all of your RRSP money as a lump sum, and this is generally not recommended as this has some severe tax consequences, especially if you have a large RRSP. Another option would be to convert some or all of your RRSP into an annuity. And if you don't know what an annuity is, I will have a video talking about what an annuity is and whether it's right for you. But the most common thing to do is option three, and that's convert your RRSP into a RRIF. So basically, the RRSP is made for accumulation, and the RRIF is used for decumulation. The RRSP is for your savings and your investing, and the RRIF is for spending. And one of the big misconceptions of the RRIF is that you convert your RRSP to a RRIF when you turn 71. But in reality, you have to convert your RRSP into a RRIF by the age you turn 71, but you can actually convert your RRSP into a RRIF anytime you want. And there's probably a lot of tax scenarios in which you want to convert your RRSP into a RRIF much earlier than 71. So first, how do you convert an RRSP into a RRIF? Within whatever brokerage you deal with, whether it's Wealthsimple, Questrade, Qtrade, RBC, TD, it doesn't matter which one, you need to open an account, and that account is just going to be a RRIF. Then once it's open, you can request a certain amount from your RRSP to transfer over to your RRIFs. It is important to note that you cannot contribute to your RRIF. You have to transfer money from your RRSP into your RRIF. You can do two kinds of transfers. You can do an in-kind transfer or an in-cash transfer. If you do an in-kind transfer, essentially you're just moving your ETFs and stocks and bonds and whatever you hold in your RRSP, and you transfer it over to your RRIF, and your RRIF will look exactly like your RRSP did. If you do an in-cash transfer, essentially, the brokerage that you're using will sell your stocks and bonds and ETFs and whatever you hold in your RRSP, and it'll just transfer the cash portion into your RRIF. Now, once your money is in your RRIF, then there are mandatory withdrawals the following calendar year from your RRIF. Why are there mandatory minimum withdrawals? When you open an RRSP and started depositing money into your RRSP, the money's been growing tax deferred in your RRSP, and you even got tax money back when you deposited money into your RRSP, but now the CRA wants their cut, and so they're going to start forcing you to withdraw from your RRIF so that they can get some of their taxes back. So when you start withdrawing from your RRIF, all the money that comes out of there will count as income and will be taxed at your marginal rate. It is important to note that when you make your transfer from your RRSP to your RRIF, there are no tax consequences, no taxes owed. Only when you withdraw from your RRIF is there taxes owed on that. So what is that minimum withdrawal from your RRIF? Well, here I've made a calculator on this spreadsheet. It essentially depends on how old you or your spouse is. You can use the age of the lower age spouse when using these numbers. And if you look at this table, I've got sort of a light orange highlight here on these percentages. So essentially, any age from 70 or younger, the formula is going to be 1 minus 90 minus your age. And so you can see as you get older, that percentage gets higher and higher. In the orange, these are just a set percentage by the CRA, and every Canadian just has to take that percentage out of their RRIF when withdrawing. And you can see here in red, once you hit 95 years or older, then you must withdraw 20% of your RRIF every single year. Now, I've just put an example here of, say, $250,000 in your RRIF. And so depending on your age, so if you retired at 55 years old, you can see here, you are required to withdraw 2.86% of your RRIF, and that would lead to $7,142.86. And that would count as income and be added on top of all of your other income and be taxed at your marginal rate. And you can see here at 65 years old, 4% of your portfolio would have to come out. So if you had $250,000 left in your RRIF at 65 years old, you would be required to withdraw $10,000. And so that might be a bigger tax hit. And you can see as you get older and older, so let's say you had $250,000 left in your RRIF at age 95, then you are required to withdraw $50,000. And that might start bumping you into higher and higher tax brackets. And that's why you probably want to see an advisor or make a plan in which you start withdrawing from your RRIF a little earlier than the required age at 71 so that you can ease the tax burden. Another thing to note is that if you were to pass away and you had $250,000 in your RRIF, that entire $250,000 gets added to your estate and is taxed at the marginal tax rate, which is likely going to be in that 50% range. So dying with a large RRSP can have severe tax consequences as well. For my wife and I, we are likely to start our withdrawals from our RRSP or our RRIF as soon as we retire, and we'd like to sort of almost empty that account by the time we start taking CPP. Another thing to note with the RRIF is that there are withholding taxes on any amount that is above the minimum. So here's a table on this spreadsheet that shows you what the withholding taxes are for each province. So all provinces are the same except for Quebec. Quebec has a provincial and a federal piece, and their provincial is a little different than the rest of the provinces. So you can see here, if you withdraw up to $5,000 more than the minimum, then you will have 10% taxes withheld. If you withdraw between $5,001 and $15,000 more than the minimum, then you will have 20% taxes withheld. And if it's over $15,000 over the minimum withdrawals, then you will have 30% taxes withheld. So how does this withholding tax apply? So let's take this example of having a $250,000 RRIF left. And let's say you're 65 years old, because that number was really nice to use. And you can see there that at 65 years old, you had to take out $10,000 from your RRIF at minimum. So using this calculator, let's say I wanted to take $15,000 out. So I need a little extra out of my RRIF, so I took $15,000 out. And $15,000 is $5,000 more than the minimum of $10,000. So that puts me here in Alberta in the 10% withholding tax. So you can see here in red that $500 would be withheld from me as taxes. So I would get $14,400 and the government would hold back $500. Now, the funny thing is if I change it to $15,001 that I took out from my RRIF instead of the $15,000, well, that's $5,001 above the minimum. And now I'm in the 20% withholding tax. And now $1,000.20 gets withheld at tax. So I take out $15,000 and now I get $14,000 and the government hold back $1,000. Keep in mind, this actually doesn't matter. The $15,000 or the $15,001 that you take out from your RRIF counts as income and will be taxed at tax time. This withholding tax is just sort of a safety net for the government, so that let's say you took out $50,000 and you had this high tax bill at the end, but you spent it all, well, at least the government has some of those taxes withheld, and so at tax time you don't have such a large tax bill. So at tax time you may get some of that withholding tax back, or you may have to pay a little bit more, but that's just part of the taxes that is owed for that year. I know taxes are one of the reasons that retirees don't like the RRSP. I've spoken to some that really disliked the fact that they were contributing to RRSPs now that they're getting taxed, but they just misunderstand this account. They forget that their money has been growing tax deferred. They forget that they got taxes back when they put money into this account. And you know what? If they spent their tax back, then maybe it was a bad decision to put money into RRSP. That's not the account's fault. This is a really great account. You can work it so that when you retire, you are in a lower tax bracket than you were when you were working. And that's a win for you. Now, a common question I do get asked is, why even convert the RRSP into a RRIF? Why not just take money out of the RRSP? There are a couple of reasons why you might want to convert your RRSP to a RRIF. The first one is because of the withholding taxes. So with a RRIF, you only pay the withholding taxes on the amount that is above the minimum required withdrawals. With an RRSP, whatever you take out as your lump sum, you owe this same percentage as a withholding tax on the entire amount. Again, in the end, it doesn't matter. You're going to be taxed at your marginal rate. Some retirees do like the fact that you are withholding fewer withholding taxes. Another reason you may want to convert to a RRIF is that when you do convert to a RRIF and you start withdrawing with money from the RRIF, you can set up a payment plan in which could be monthly or quarterly or annually or something like that. Many financial advisors will say keep the income stream the same as when you were working. So I get paid monthly as a teacher, and so they would recommend that I should set up a RRIF withdrawal payment plan every month so that it feels like it's the exact same as when I was working. With an RRSP, you don't have that option. You do have to set up the withdrawal every single time, and so there's a convenience factor there with the RRIF as well. Another reason that you might want to convert to a RRIF is that when you take money out of an RRSP, generally brokerages will charge you a $50 deregistration fee every time you withdraw from your RRSP. With a RRIF, there are no such fees. The account is made for withdrawals, so there are no fees for withdrawing from your RRIF. And the big reason that you want to convert to a RRIF, if you are 65 years old or older, then you can income split your RRIF. You cannot do that with an RRSP, but with a RRIF, you can split up to 50% of your withdrawals with your spouse. And this could potentially save you thousands of dollars in taxes. So I hope this video has been informative and has shown you what a RRIF is, how to use it, how it's taxed, how the withholding taxes work. And if you've enjoyed this video and would like to stay informed of some of my other ones, please subscribe below. Have a wonderful day.